This is Nightly Business Report with Sue Herrera and Bill Griffin.
State of the economy. The Fed speaks, but focus turns to the economy's three vital organs: jobs, housing, and the consumer.
Shifting gears, why auto sales tapped the brakes to start the summer.
New option. Short-term health plans could soon play a much larger role in the insurance industry. Those stories and much more tonight on Nightly Business Report for Wednesday, August 1st.
Good evening, everyone, and welcome. The economy was front and center today, and we learned a lot about its three pillars: employment, housing, and the consumer. So let's begin with jobs. Companies added a lot more workers to their ranks than expected in July. According to the payroll processor ADP, 219,000 jobs were added. That's the most in 5 months, and it comes despite a shrinking pool of qualified workers. That report sent the yield on the 10-year Treasury back up to 3%.
Now to housing, which saw demand drop nearly 10% in June compared with a year ago. A new report from online realtor Redfin called it the biggest decline in more than 2 years. Not only that, but the number of people requesting home tours also fell, and it seems that red-hot prices, rising mortgage rates, and a lack of listings at the entry level are all still taking a toll on potential buyers.
And the third pillar of the economy is the consumer. The recent GDP report showed a surge in spending in the second quarter, and that's significant because consumer spending makes up about 2/3 of economic activity.
So putting it all together, preliminary estimates from the Atlanta Fed today show that the economy could be growing by as much as 5% here in the third quarter. Let's dig deeper into these three pillars of the economy with Beth Ann Bovino. She's chief U.S. economist at S&P Global Equity Research. Beth Ann, always good to see you. Thanks for joining us tonight.
Great to be here.
Let's start with jobs. I mean, that is just a cornerstone of the economy, and it has been very, very tight. How much better does the job market get, do you think?
Well, I think one thing is that after such a lackluster jobs market, it's great to see that it's healthy again. We're expecting some nice readings for Friday. We're looking for, actually ours are probably going to be on the low side given the readings from ADP. But overall, the jobs numbers are holding up rather well. We think it's going to last through the year. Indeed, we expect to see that unemployment rate drop to about 3.6% by 2019, a nice reading.
Let's turn to the consumer. We just really highlighted how important they are to the economy. What's your best guess as to whether that can continue at the rate that it has been growing?
I should add that while the jobs numbers are holding rather well and people are getting more jobs, we're also expecting to see higher wages, which is going to help consumers. We're looking to see wages actually pick up to probably around 3% year over year by year end and climb higher further than that. And so with the consumer having a little bit more money in those, well, first there's more jobs and also a little bit more money in their paychecks, that means they can spend a bit more. So we are expecting to see consumer spend actually pretty nicely for this year. They're also helped by that tax package. So that means they can spend a little bit more nicely this year. I think we're thinking kind of around 2.5 or around that percent, a pretty nice reading for this year. Slowing a bit in 2019, but it's still going to be above that trend growth rate for consumer spending of 2%. A good reading indeed.
If there's a weak link among the three, I guess it would be housing. And a lot of people look to the bottleneck that occurs, not enough inventory out there. But you also look at another factor. Weather, you think, is playing a big role here as well, don't you?
Well, I think there's a few other factors that are probably not as nice to say that it's a one-off. We do think that weather probably explains some of that drop most recently, largely because the fourth quarter we saw a big rebuild. Don't forget that we had a massive amount of hurricanes and also fires, which crushed a lot of homes. And of course, you need to rebuild them. So that explains the big boost, and then of course the unwind thereafter. But of course, there's other factors involved, not just weather. That it can explain some of it, but not all.
Beth Ann Bovino with S&P Global Equity Research. Always good to see you. Thanks for joining us again tonight.
And of course, no one pays more attention to the economy than the Federal Reserve. Today, policymakers painted a rosy picture of the economy and kept interest rates at their current levels. But as Steve Leisman reports, they also suggested that a rate hike at the next meeting is likely.
The Federal Reserve kept interest rates unchanged at its July-August meeting, but signaled further rate hikes ahead as it upgraded the economic outlook from solid to strong. The benchmark Fed funds rate was left in the range of 1.75% to 2%, but the Fed gave every hint that further rate hikes are on the way at its meeting in September, saying, quote, further gradual increases in the target range for the federal funds rate will be consistent with sustained economic expansion of economic activity. That's Fed speak for more rate hikes are coming. Indeed, the market traded that way. September probabilities for a rate hike at that meeting, 88%, December 62%, in June 19, 61% probability. After the meeting, Greg McBride from Bankrate.com wrote, quote, all signs still point to a September rate hike. Continue paying down variable rate debt such as credit cards and home equity lines and refinance adjustable rate debt into fixed rate to insulate yourself from further rate hikes because there will be more. The Fed said in its statement the labor market has continued to strengthen. Job gains were strong in recent months and the unemployment rate has stayed low. Household and business spending both said to have grown strongly. Inflation is seen remaining near its 2% inflation target and the risk to the outlook roughly balanced. Also interesting what was not said in the statement. No mention of whether the Fed thinks the strong growth levels can continue or of the possible economic effects of tariffs or any response to the president's criticism of its policies. That may come later this month when Fed Chairman Jay Powell speaks in Jackson Hole. For Nightly Business Report, I'm Steve Leisman.
So while the economy overall may be strong, sales of new cars last month were weaker than expected. The numbers released today for July came in below the pace that we've been seeing all year. And as Phil Lobo reports now, buyers continue to steer clear of cars and sedans.
It is too soon to call slower July auto sales the start of a summer swoon for automakers. After all, the overall pace of business remains relatively strong. But aside from Fiat Chrysler beating expectations with a 5.9% increase, Ford, Toyota, and many other automakers saw sales fall last month. So what's going on? One factor may be fewer special deals in the second half of the month as dealers come off big promotions for the 4th of July. But another factor could be the slow but gradual rise in interest rates for auto loans. That may have some buyers pausing before signing up for a monthly payment. Still, dealer chains like AutoNation are not worried about business slowing down.
The consumer is still very much in the marketplace for new vehicles. I don't think that's really the issue. And of course, you have this massive shift towards trucks, which is now approaching 70% of the business. So this year will be high 16 million, if not touching 17 million on a unit volume.
Even with slightly slower sales in July, this year's annual auto sales may hit 17 million vehicles for a fourth straight year. The question is whether July is just a blip or the start of a summer swoon. Right now, analysts, automakers, and dealers all expect sales to remain robust for the remainder of this year. But if business drops again in August or September, well, then we could be saying that auto sales are truly shifting into a lower gear. Phil Lebeau, Nightly Business Report, Chicago.
Separately, Ferrari's new boss said today that the profit goals set out by his predecessor, the late Sergio Marchionne, were what he called aspirational. So the automaker said it is now planning to present a new 5-year plan to investors and analysts in September. That sent the stock down by 11% in today's trade.
The one thing that many experts agree could hurt growth is trade policy. Today, the Trump administration said it is considering increasing the level of tariffs on $200 billion worth of Chinese goods from 10% to 25%. Beijing has threatened to retaliate with its own measures.
To Wall Street now. Tech shares rose thanks to those strong earnings that we saw from Apple that we told you about yesterday, but broader market gains were capped on those renewed trade concerns. The Dow, when all was said and done, fell by 81 points to 25,333. The Nasdaq, though, rose by 35. The S&P was down 2. Now that we're most of the way through earnings season, investors want to know what the market's going to focus on next. Mike Santoli takes a look.
Record corporate profits have built a cushion under stocks, but is the market due for a rest as it enters August? Over the past 5 months, the broad S&P 500 index has worked its way to a 5% gain for the year and is within about 2% of its January record high. But that progress has come in fits and starts, with an impressive 20% pace of corporate earnings growth pushing stocks higher, while worries over a trade war, higher interest rates, and the risk of an eventual recession exert some downward pressure. These opposing forces have left stocks more attractively valued than they were at the start of the year. The S&P now trades at about 16 times expected earnings for the coming year. That's right in line with its 5-year average and down dramatically from the peak in January of more than 18 times. The earnings surge, helped by the tax cuts passed in December, but also reflecting a sturdy global economy, has not yet generated broad-based momentum in stock prices, though. Those nagging concerns about a trade war that could slow the world economy and disrupt corporate supply chains is one possible reason. Another restraint on stock prices has been a general concern over whether the first half of 2018 might represent the peak for economic momentum and corporate profit growth. The U.S. economy's expansion is already the second longest on record. Commodity and labor costs are rising, and the Federal Reserve is poised to raise rates for the 8th time in 3 years. Add to this the fact that August and September are historically two of the weakest months for stocks, especially in midterm election years, and perhaps it makes sense that the indexes might pause or pull back a bit this month. Of course, seasonal factors don't usually drive large market moves on their own. Forecasts for corporate profits have continued to move higher in recent weeks, which ultimately should be reflected in stocks. And the market has managed to absorb plenty of political noise and trade frictions while keeping its long-term uptrend very much intact. So even if August does bring a late summer storm warning to Wall Street, it's too soon to say the days are growing short for the bull market itself. For Nightly Business Report, I'm Mike Santoli.
It is time to take a look at some of today's upgrades and downgrades. Electronic Arts was upgraded to buy from hold at Argus Research. The analyst cites the stock's recent pullback ahead of major game releases in the second half of the year. The price target is $155. The shares fell about 1% to $127.48. Sarepta was upgraded to overweight from equal weight at Morgan Stanley. The analyst cites the stock's recent sell-off and the prospects for its Duchenne muscular dystrophy gene therapy program. The price target is $163. The stock rose more than 3% to $120.27.
Papa John's was upgraded to buy from hold at Jefferies. The analyst there believes that the board may evaluate strategic alternatives for the company. You know what that means, given the recent departure of its founder. Price target $58. That stock rose a fraction to $42.27 today. First Solar was added to the focus list at J.P. Morgan. The analyst says that this is an attractive entry point for a best-in-class company, as he put it. The price target $79. Shares rose nearly 2% today to $53.38.
Still ahead, lower-priced health care coverage, but does it come at a cost?
Well, investors were watching shares of Apple today to see whether they would hit that $1 trillion mark in market valuation. Didn't happen. So here's where the three biggest publicly traded companies stand at the moment. Apple is in the lead. Market capitalization of $973 billion. Amazon's now a distant second, followed by Alphabet.
The Treasury Department has proposed some rules on how companies can bring home income sitting overseas. That income now amounts to more than $2.5 trillion. Experts say this is a key step in the process known as repatriation. The tax law signed at the end of last year allows companies to bring the money back at a special low interest rate.
Short-term health plans are soon going to play a larger role in the insurance market. The Trump administration has outlined new rules for coverage as an alternative to the Affordable Care Act. Bertha Coombs has details for us tonight.
Short-term health plans appeal to consumers like John Conley, who earn too much to qualify for subsidized exchange plans but can't afford premiums for ACA coverage. The Trump administration says new rules extending the duration of those plans will offer relief for people like the Arkansas contractor.
But these can be very affordable options. They may be as much as 50 to 80% cheaper than the Obamacare exchange plans. So this is a really important option for millions of Americans.
Under the new rules, insurers can offer short-term plans that last up to a year. That's up from 3 months under the Obama administration. And they can be renewed for up to 3 years. The timeline taken from COBRA, the employer insurance program for workers who lose their jobs. Unlike COBRA, short-term plans aren't required to provide Affordable Care Act benefits like preventive care and pregnancy coverage or protections for pre-existing conditions. Less robust coverage makes premiums cheaper.
What a lot of times consumers don't realize when they're buying these plans is that they don't cover very much. So if they get sick or get injured, and all of a sudden the bills start to pile up.
Critics worry the new plans will siphon off healthy consumers from the exchange market, a charge Secretary Azar refutes.
The Obamacare individual insurance market on the exchanges is largely drawing to the tune of 87% people who are getting subsidies from the taxpayers to buy their insurance. People are not likely to walk away from insurance that they're getting for free or heavily subsidized.
Yet the administration's own estimates are that 200 to 600,000 exchange members will make the shift in 2019. Exchange insurers could too.
If they are worried that they're going to lose their healthy enrollees to these short-term plans, I think many of them are going to feel like they have to offer them too. So you could see a real race to the bottom here.
Insurers can begin selling the new longer-dated plans in October, just as Affordable Care Act open enrollment kicks off for 2019. For Nightly Business Report, I'm Bertha Coombs, New York.
Humana raises its full-year earnings forecast, and that's where we begin tonight's Market Focus. The health insurer lifted its profit expectations after saying stronger membership growth in its Medicare business caused results to top street targets. Humana also said it plans to build upon its existing partnership with Walmart, which offers patients a co-branded Medicare plan. Shares rose more than 1% to $318.14. After the bell, the pharmacy benefits manager Express Scripts reported better than expected earnings and said it expects customer retention rates to improve. The company also raised its 2018 earnings guidance. Separately, the Wall Street Journal says billionaire and Cigna investor Carl Icahn plans to vote against the health insurer's acquisition of Express Scripts. Shares of Express Scripts initially fell in after hours, but then rose. They finished the regular day off 6% to $74.44. Following a quarterly earnings beat, Nutrisystem said it's betting its recently launched DNA product will drive even more growth.
Where the world is going is towards personalized nutrition, and what this does is allows you to take a test that then, based on the results, we will be able to tailor your program based on what your DNA says. That's really important these days because what everybody is looking for is customization. It'll tell you about your metabolism, it'll tell you about your eating behaviors, it'll tell you about your nutrition, what nutrition concepts are best for you, and it'll tell you about vitamins.
And when it comes to competitors in that space, Nutrisystem said it is hoping innovation and its multi-brand strategy set it apart. Shares fell 4% to $38.30. Sprint grew its customer base at a quicker than expected pace, helping earnings top expectations. The wireless carrier did warn that higher prices for its new phone plans could cause subscriber growth to slow. Shares of Sprint fell nearly 1% to $5.38.
SodaStream said that increased demand for its sparkling water makers and gas refill units led to its most successful quarter ever. The company reported profits and sales well ahead of estimates and said that it expects earnings for the year actually to be triple its previous guidance. SodaStream shares spiked 26%, no surprise, to $110.30 today. Then after the bell, Tesla reported a wider than expected loss, but it wasn't all bad news. Total sales edged past expectations and gross margins improved. The electric automaker also said it expects cash reserves to be higher in the second half of the year. Shares initially rose in the extended hours. They also finished the regular session up nearly 1% to $300.84. Also after the bell, Wynn Resort said that weakness in its Macau hotels and casinos offset strength in other areas, causing overall earnings to miss the mark. Shares of the casino operator fell after hours, extending a 4% loss from earlier in the day when shares closed at $159.99.
And gambling is a multi-billion-dollar business. And today, one of the biggest names in that industry sent a chill through the sector. Caesars Entertainment gave a cautious outlook and warned of tough conditions in Las Vegas. The stock plunged more than 20% before paring some of those losses, and it sent the other gaming stocks lower as well. Contessa Brewer has more.
Caesars stock plummeted today while CEO Mark Frisora was delivering his earnings conference call. So why the dip? Caesars told analysts it's suffering from some competitive pressure on room rates and a shortage of scheduled events in July and August in Las Vegas compared to the previous year when the Mayweather fight happened. That sent the stock skidding, at one point off by 24%. Such intense volatility, trading was halted 3 times. But Frisora says there's no reason to panic.
We had some cautionary comments that, we'd seen some softness, not due to Vegas being soft, but due to the event planning in the window of like the third quarter, a little softer than it was a year ago. So this was not any kind of a condition around Vegas that is softer than we anticipated. It just had to do with more event planning.
Caesars has just launched sportsbook operations in New Jersey this week and plans to roll out sports betting in Mississippi by mid-August. And by football season, the casino giant says its mobile sports gaming will be available throughout New Jersey. But we'll have to wait to hear whether revenue from sports gambling offsets the predicted softness in Las Vegas hotel occupancy. Overall, Caesars predicts 4 to 6% growth for 2018. For Nightly Business Report, I'm Contessa Brewer.
Coming up, more investors are swapping stocks for bonds. Should you? Here's a look at what to watch for tomorrow. CBS reports earnings. There are reports that CEO Les Moonves will be on that call. This follows, of course, the allegations of sexual misconduct against him. Jobless claims will be the final read on the jobs market before Friday's employment report. High-end speaker maker Sonos is widely expected to make its trading debut. So it should be a very interesting day to watch tomorrow, Thursday.
Absolutely. Wells Fargo has agreed to pay a $2 billion fine over mortgage-backed securities. The bank and the Justice Department had been in negotiations for months. This ends the long-running investigation into that matter. Wells Fargo is also facing federal and state investigations into its sales practices.
Fidelity is now the first fund company to offer core index funds with 0 fees. It's all part of a move by Fidelity to lower expenses and make investing easier, even for those with only small sums to put into the market. Separately, Vanguard plans to offer free trading on more than 1,800 ETFs this month. Both decisions intensify the price competition that has already taken hold in the asset management industry.
As we reported earlier in the program, the yield on the 10-year Treasury hit the key 3% level for the first time since June. According to the investment company Institute, investors for months now have been moving money into low-yielding bond funds and out of relatively high-performing stock funds. So why is this happening? David Dietz joins us. He's the president and chief investment strategist at Point View Wealth Management. And I bet you have some answers to that. Good to see you, David, as always.
Welcome back.
Thank you, Sue. Bill?
Why that rotation from stocks, which have done pretty well, into bonds?
So there's many good reasons, but one classic one is just the rebalancing strategy. Rebalancing basically looks at the outperforming asset class and then sells some of that to rebalance so that you get back to your pre-programmed asset allocation. In this case, so for example, over the last 12 months, the S&P 500 with dividends is up nearly 16%, while the 10-year Treasury, including income, is down almost 4%. That's a 20% disparity. That's a wake-up call to take some of those chips off the high-performing asset and buy it into what's now underperforming.
I know you agree with this, right? You're doing this with your clients' money, but bonds, as rates are going up, the Fed's raising rates. Bonds should not perform that well. Where do you put that money for income then in bonds?
So we're cautious to tell our investors bonds have not performed that well. But, you know, if you think predicting the stock market is hard, try and predict the interest rate market.
Right.
You started the year with 2.4% on the 10-year Treasury. As we just heard, we're now over 3%. That's a significant increase. So really, bonds are actually more attractive now than they were at the start of the year. I say take advantage of that with a portion of the money and rebalance back to neutral.
How do you feel about equities overall, though?
You know, so still, even with that 3%, most people can't make their retirement or distribute from their endowments or institutions what they want with that. So I still think there's going to be a strong bid under that equity market. So I think the answer is really to look for those areas which have been kind of laggards. Many of the value areas have been laggards. Many of the areas overseas have been laggards. The only one that would be a little cautious on is some of the FANGs, the ones that people are talking about at the cocktail parties.
One of the classic debates, bond funds or buying the bonds outright. What do you say?
Well, you know, it really depends on your horizon. But if you've got a long enough horizon, I say buy the bond outright. There's so many good reasons. One is, of course, you save the fees and the fund, but also you're locking in a guaranteed profit. You know what your interest payments are going to be. You know what you're going to get at maturity and when that maturity is going to be. With the bond fund, it goes up and down. You never quite know the value when you're going to need the money.
Quickly, where would you be on what's called the yield curve or the duration of bonds?
Well, you know, certainly with the yield curve flattening, there's a great case to be made now for it to go shorter. For example, that 2-year Treasury now close to 2.5%. With the 10-year at 3%, you don't get that much more to go an extra 8 years of risk. So I would say go a little bit shorter, all things being equal.
David, great to see you again.
My pleasure.
David Dietz with Point View Wealth Management.
Before we do go, one final look at the day on Wall Street. The Dow fell by 81 points. Pretty volatile day, as a matter of fact. It was higher early on. The NASDAQ rose by 35. The S&P was down 2.
And that will do it for us tonight on Nightly Business Report for August 1st. Can't believe it. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.